It is not unreasonable to get between 15 and 30% a month. I've even had months where I've done more than 30%.
Today, we're talking about a little known income strategy that combines the best parts of put credit spread and calendars. It's called the rolling put diagonal. My guest has over 25 years of trading experience, and he's refined this into a steady, repeatable system. Welcome to Bill Belt.
Thanks, John.
Before we dig into all the details, give me the 40 seconds pitch of what the rolling put diagonal is.
Yeah, the rolling put diagonal has been a very successful strategy for me because it combines flexibility with options and what I believe is a pretty high rate of return or yield on the margin or buying power that I'm using. What is a rolling put diagonal? Because a lot of people that I talk to, they think, oh, I'm very familiar with it, and what they're really thinking of is a poor man's covered call, and this has nothing to do with a poor man's covered call. Some people call this a short put diagonal. Some people call it a credit diagonal, but at the end of the day, it's basically a spread that is a hybrid between a calendar spread and a vertical spread. So as a result, you have two legs, one leg being your income leg and your long leg, which is further out of the money in the put side, being your protection or being your buying power management. And the rolling put diagonal is the strategy that has been the most successful for me. So it's the one that I talk about the most, and I've kind of done deeper dives into it to try and make it better.
Before we dig too deep into the strategy, I have just a question about yourself. Have you been trading option all those 25 years?
Mostly, yeah. I started back in the late 90s, to be honest with you.
Mm.
I did very, very well at the end of 99 when it was the dot-com boom. And then come 2000, I didn't do so well when it busted. And I was like, I have to find something that's going to be a little bit more flexible, something that's going to give me protection. And for actually years, I was looking for something like that. And that's when I started following the money press and became good at that. But then when options became 3 days a week, Monday, Wednesday, and Friday at the indexes, I wound up doing those, and the organization that I was following didn't want to do that. So I just went off on my own and started perfecting the 3 days a week, and then it went to daily on some of them. I moved to that. So that's how we got to where we're at today.
We will dig into your rolling put diagonal, but first I think we should define what is actually a diagonal.
A diagonal is a spread with two legs that is a short leg and a long leg. Buying power is based on the difference between those strike prices. The diagonal happens to be different from the vertical because the vertical is in the same expiration period. The diagonal has two different expiration periods.
Before we go deep into your rolling put diagonal, what are you trying to achieve with this strategy? What is your goal?
Well, the goal is income. What I am doing basically probably about 15 to 35 or 40% per month of return on investment using the amount of buying power that you're using in the month. So I'm very happy with that kind of return. And if I can keep on growing with that, my overall goal, let's be a millionaire. So that's where I want to go with this.
So let's start to describe in more detail the rolling put diagonal and how you open a new trade. And which underlyings are you primarily using?
Well, usually I'm between SPY, XSP, and QQQ. Those are the three underlyings that I like. XSP, I like that one because it is based on a European expiration, which means it cannot be assigned early. I am not afraid of SPY or QQQ either. As a matter of fact, right now I'm using mostly QQQ because it has a higher implied volatility and therefore I have a higher premium with each week, each day.
So let's then think that you are opening a new diagonal today.
Okay.
What are the mechanics you will follow?
Well, what I'm going to do basically is I'm going to sell to open tomorrow's at the money strike price with tomorrow's expiration.
Mm.
And then I may look at 14 days to expiration or maybe 30 days to expiration. And I want to go to about a 30 to 35 delta. The rolling put diagonal is an income strategy that utilizes delta management. What I want to do is to make sure that my short has the higher delta and the long has a lower delta. So as the depreciation goes into my pocket, I'm getting the income from the short leg. So I may sell the current one for, let's say, $1.50 or $2, and I may buy the current one back at, let's say, a quarter or 50 cents. So that in between there is my profit. And
Mm.
every day I will roll. And I will roll to either at the money, or if the price has gone down, do a horizontal roll.
So let's bring up an illustration that you have that makes this maybe easier to understand.
Sounds good. So when you first open a rolling put diagonal, you are opening up at a debit. Because the long leg is out 14 days to expiration, 30 days to expiration, whatever you're comfortable with, you're going to be paying more for that than your short leg. But it's through consistent rolling of the short that you accumulate the money for to turn that into an overall credit campaign. You'll notice here on here, so your short leg, you're constantly getting income from that at a greater rate because it is a higher delta than your long leg. So at the end of a number of rolls, you basically are putting more money into the coffers. So at the end of the campaign, you basically have an overall credit.
So you mentioned that you roll this trade, the short, quite frequently. Tell us the mechanics and your rules for rolling in under different situations.
Again, this strategy is a game of delta management. So as a result, every day I would wind up taking the short and rolling it to the next day's, or I might even go out a couple of days. Sometimes there's an event to take place that adds to the volatility, and I'll notice that the premium is more for a particular day than if I would have rolled every day, if that makes sense. And so I may go out 2 or 3 days and collect that extra premium from the implied volatility. But bottom line is, it's basically doing every day rolling out. If the price goes up, I still go at the money. If the price goes down, I don't go to the at the money again. I go to the same strike, so I'm doing a horizontal roll. The reason I'm doing a horizontal roll when the price goes down is because there's extrinsic value now and intrinsic value in that option. So when I take it and I roll, for example, in this case, it might have been on September 4th, 5th, it looks like there was a drop in price, minimal drop in price. And you'll notice in my chart, I've got a white line. That white line is a 9 EMA. And I
Okay.
use that a lot to feel whether I want to stay in the trade or not. Because if it drops below the 9 EMA, that's a red flag to me.
What are the two other graphs we see in your indicators?
The middle is a MACD histogram, the bottom is a CCI.
And the top one?
The top one is the price graph with Keltner channels, basically with a 2 or a 3 value in there, and then you've got EMA 9 and EMA 18 in there.
When do you close this trade?
I roll that trade around noontime. I close down the campaign either at the end of the long, a day before the long, 2 days before the long, whatever. And then I'll decide, do I want to open up a new campaign so I continue that campaign, or is it time to sit on the side in cash and wait for another opportunity?
This is, if I understand it correctly, bullish trade or maybe market neutral, but it's
It,
not good in bearish conditions. Is that correct?
it exactly, that's spot on. And as a matter of fact, it's slightly bullish is a good term for it. Um, this is not a jack of all trades sort of strategy. This is slightly bullish, flat, something that spikes. So you take something like Nvidia. I wouldn't do this on Nvidia because Nvidia has had too many spikes along the way in the last year that I've seen. I like the index. Yes, there can be spikes in SPY or in QQQ, but usually the trend is slightly bullish or flat. If it goes negative, and when I say goes negative, I'm talking about on a weekly chart, it's time to close it. I do not recommend people try and follow this through. I also do not recommend people try to do this on the call side to do a double diagonal. I've never been successful with a double diagonal or on the call side. Sooner or later, it bites me because all of a sudden, we've been in a bullish market for years. And sooner or later, you get that whiplash that all of a sudden it goes the other way and you lose a ton of money. And the reason you lose a ton of money is because you're invested in the long and you're invested in the short. So that short having a higher delta is going to lose more if it goes against you.
So, how do you deal with this trade if the market falls fast and suddenly?
Well, if in a perfect world, the chart that I look at gives me a heads up. CCI I've seen gives me a heads up that it's overbought. I've seen the MACD histogram start coming down. I've seen the pricing fall through the EMA 9. So using those kind of indicators has helped me close it down instead of trying to hang on and hoping that I'm not going to get thrown from a bucking bronco, per se. One of the worst things in the world on this trade is to hang on to it too long. One of the people that's in one of the discords has a tendency, once CCI gets to the top, they'll close it down and wait for it to come back. Now, I've seen them close it down early and they miss out on some more rolls, but at the end of the day, they also don't get into the downdraft when it does correct itself. Usually, the graph gives you a heads up. That heads up may be way in advance. To be honest with you, there are the times that you need to just close it down and take a loss, but you do have a protective long position there. So that protective long, as long as you don't have the deltas being too far apart, is going to help protect you.
What is the worst that can happen with this strategy?
The worst that can happen is the difference between the short and the long. So you basically are taking the spread and saying my maximum loss could be X amount. So that's one of the reasons why in the manual that I have on the Facebook page, you'll find that I do talk about rolling up the long when it gets to be too far down. In other words, if you're looking at overbought, you're looking at some indicators, or you're looking at potentially bad news, you either go ahead and close it. I close for FOMC meetings as an example. I just don't want to be there when the FOMC makes their announcements. And then the day after FOMC, I may reopen it again. But if you manage your deltas, you manage your risk as well. So in other words, if I have a 50 delta short and I feel that I want to have tight protection, I'll have a 35 to 40 delta long. If I am comfortable that I'm doing okay, I may have a 30 delta long. So it depends on where I feel that the risk may be at, and is it time to tighten it up or not. And the chart tells you a lot, like I say, as far as are you overbought or are you at a potential risky spot. It's better to close it early and sit on the sidelines than it is to, sit out there. That is today's chart. CCI has made a downturn. I may
Mhm.
close it down in the next couple of days
Mhm.
because it's end of month, end of quarter. CCI is turned down in the overbought and looks like it's ready to start coming through. But you never know how long it's going to stay high.
Mhm.
Right now the histogram has got a couple of charts that have come down. The pricing is above the EMA 9. Right now I'm playing it relatively conservative. I don't have my long leg too far out. So if I do wake up tomorrow and, there's some kind of a disaster or whatever bad news or whatever, what I'm going to lose is the difference between the strikes of the two. I also know people that have taken off the short and let the long continue. I don't necessarily do that, but it's something that people do. I don't do it because, again, I know that the pricing can turn around in a heartbeat and go back up again.
But this is not a leave and forget strategy. It does require regular management and both of not the least of the delta position. Isn't that correct?
Daily management, daily looking at, but you only have to look at it for a few minutes. I check it out probably 3 times a day, an hour and a half or so after the market opens, lunchtime, and the last hour of the day. This is not a day trade. This is not something where you should be looking at your net lick value, because if the price does go down and you do a horizontal roll, you are collecting intrinsic value that's going to come back to you when it comes back up. So this fit very nicely into my lifestyle. I am currently retired, but when I wasn't retired, it fit nicely into my job. I didn't have to sit in front of a machine. I could look at my phone at lunchtime. 2 o'clock, I would take a quick peek at it, but I didn't have to sit there glued to a computer.
Bill, I like to ask my guests to put their strategy on a risk profile scale from 1 being very low risk and 10 being very high risk, and you can define it as you want. Where would you put your rolling put diagonal on such a scale?
If the market is correct, in other words, you're not trying to force a square peg into a round hole. So if you are doing it in a flat to a slightly bullish market, it's a low risk strategy. If you are trying to put it into a declining market, it's a high risk because you're banking on the market turning around. So the
Mhm.
first thing is make sure your environment is the right environment.
So it's not a strategy that you can easily just backtest, I understand.
Now, because of the rolling, I've had a number of people that are way smarter than me try to do this and they're not able to. They've even tried to the point of closing it down at the end of the day. But that's not truly representative of the return on investment that you get. You're closing the long and the short at the end of the day and reopening up the next day. You've got a bid-ask spread on the long position, so it's not a case where you can easily do it on a risk graph. I've done it manually, and I think that's probably how you have to do it. It is a long and tedious process, but it is one that's worked and it's helped me refine what I'm doing. It's also helped me kind of understand what I'm doing because I used to think that this is something I wanted to do the first thing in the day, and I find out that it's probably the middle of the day that's the best time for it. And so again, it helps me understand the mechanics and how to do it. It's something that I would suggest somebody that's learning this strategy go ahead and do it, whatever they use, whether it's toss on demand or whatever they're using, do this thing manually on a spreadsheet. I also have a spreadsheet that I have on the Facebook page pinned to it or on the different that I publish on. So
And we will, of course, share the link to your detailed trading plan and also the link to the Facebook group that you are running, where you are very responsive to questions other people may have.
sure.
Bill, I'm sure everyone is curious now about your results. How do you measure the results of this strategy, and what have been your results over time?
The results that I have are based on what's my income that I'm getting versus the maximum buying power that I've had to use during the campaign or during the month. You may see a number like, the month has given me, let's say, $5, for example. And you may look at that and go, that's not all that much. But when you see that the maximum buying power per contract that I've had to use is, let's say, $1,000, that's not that bad. And when you start turning it around into the percentages, my percentages basically are anywhere from 15% growth of buying power to, I mean, I've had months as high as 30 and 40%. So it depends on how the market goes. It depends on how the volatility goes. But again, at the end of the day, I am basing it on how much I'm doing, and that's per contract.
So 15 to 40% per month as measured towards the buying power you have used. That sounds
Yes,
like amazing results. What is this in annualized return?
annualized is anywhere from a 2x to a 3x return, 200% to 300% of the buying power.
How much of your account are you using in buying power? I assume you're not using 100% of your account.
No, I'm not. I use about 25% of my account. The other 75% are basically sitting in stocks or whatever. But I'll use 25% of the account. Now, the nice thing I like about the strategy, there's two things that I really like about the strategy. Number one is the flexibility because it gives me a lot of different options. But the second thing that I like is that you can always count on time giving you more premium. So in essence, the market is going to give me more money to just sit and wait.
So let's sum up this strategy. How would you do that? Or maybe more specifically, what are the 3 to 4 most important takeaways you want to share with other traders who would consider this strategy?
The first thing is you need to have the right market. So again, don't do this when the market's going down. I happen to use some custom time frames because I want to use equal time slots. So I use a 98-minute, that's a custom. I use a 130-minute, that's a custom, and then I use day and weekly. A 98 may show that it's market has gone down, but the daily and weekly are still showing a bullish market. So the first takeaway is don't put a square peg in a round hole. The second thing is you have a lot of flexibility and a lot of options here, not only to manage it, but also to help yourself out. So, you know, we don't use stop losses here, we roll. If I were to use a stop loss, I've used the example of that's a nail in the coffin. You lost the money, you've given up. With a roll, yes, you've done a buy to close, but then you've also done a sell to open. So you've kept the trade alive with a roll. The third thing that I would say is important here is don't look at this every day or every minute. I mean, this is something that it's a trend. It is not a day trade. Look at your momentum. That is really what you're getting your gains from. And then the fourth thing is have fun. Use the money for your family and use the money to pay your bills. I used to have a job where I worked 12 hours a day, 16 hours a day. With the income from this, and I'm going to say it is not unreasonable to get between 15 and 30% a month. I've even had months where I've done more than 30%. But again, don't blow up your account. Don't put 100% into it and then all of a sudden go, what am I going to do? Because there was some disaster or there was another tariff announced or there was somebody that was announced that they were going to jail or whatever. I've been through a number of bad news events and it always turns around. Just make sure you're in the game so that you can turn around, whether that means staying in cash or continued rolling.
How many losing months have you had?
Two last year.
How long time you had been trading this?
I've been trading it for about 3 or 4 years, I think.
So only 2 losing months is very
Two
good.
two losing months, and they were months where you woke up in the morning and S&Ps were down over 100 points.
Mm,
I will be honest, and I'll say one of those months I panicked and I said, "Time to close." And I shouldn't have closed. I should have continued rolling because later on the next day, actually, it all came back. And
mm,
it kicked myself in the tail, but if I would have rolled, I wouldn't have done. In the guide, I do say in my trading plan, I do say, you know, make sure you've got two agreeing candles before you make any action.
mm.
And I think that's been a good piece of advice that I've had given to me is don't move too fast.
Bill, what would be good resources to learn more about this strategy, but also about options trading in general?
Well, there's a lot of people that want to use YouTube, and I think that's a great start. There's a number of people that use coaches. I can tell
Mm,
you that the one that I learned the most from is an organization called Trader's Edge, and they're the ones that have the money press, so you can learn a lot about the diagonal
mm,
from them. There's also a lot of other organizations that have it. Maggie Roth has one called Investing Buddies. And part of their goal is to teach newbies how to trade the options and what options do and things like
mm,
that. My biggest advice is don't throw a bunch of money in it right away. Learn by paper trading.
mm,
I can't impress enough if you are in cash, you're not going to lose money. Cash
mm.
is a great position to be in. Doing it on paper is a great learning tool as well. Give yourself 6 months of doing this or 3 months of doing this, depending on what level you're at in order to get this down.
Would you have one or two good books on options trading to recommend?
I'll be honest with you, all of the books that I have are old. Options as a strategic investment is probably the best one that I've ever read, but it's also the cure for insomnia. Um, there's been others that I've liked. Trading as a Living that you'll find in on Amazon. There's a couple of those out there that really help out. I would stay away from somebody who's going to promise how easy it is and show you in his Lamborghini what you can do with options. That's not the real world. And yes, learn. Go ahead and read up on the books, but the best thing is learn by doing.
We will share the links both to your Facebook group, your trading plan in the article that is accompanying this video. Bill, thank you very much for sharing your rolling put diagonal with us in such an insightful way. Thank you very much for joining.
Thank you for your time. I appreciate the opportunity.